So when it comes to deferred payments versus vendor finance, they are essentially one and the same thing. So when it comes to a deferred payment, you are essentially saying to the vendor, look, I'm going to buy this property for £1 million, for example, but I'm going to give you 500 grand up front, and then I'm going to give you 500 grand come completion and sale of the units. Whereas with vendor finance, you're saying to the vendor, I'm going to give you £1 million, but you're going to give me £500,000 back, and I'm going to pay you interest on that for 12 to 18 months, whatever it may be. So when it comes to the two, deferred payments are you're just sending over a chunk of the purchase price, whereas vendor finance is they're actually sending you a chunk of the purchase price back in order to finance the purchase of the property. When it comes to development lenders, deferred payments aren't looked at as favourably sometimes as vendor finance, because weirdly enough, despite them being one and the same thing, it's much easier for lenders to get their heads around vendor finance as it is to get their heads around deferred payments. So when it comes to that, sometimes structuring it as a vendor finance deal is actually slightly easier than deferred payments, but that's the difference between the two. So when it comes to negotiating deferred payments and vendor finance deals, you've got to, as with every other strategy, find the win-win, find the pain point, find what it is that they need. Now, a lot of you who follow me on social media will see obviously that we're doing a lot of deferred payments ourselves. We found that the pain point for the vendor was that they had lots and lots of land, a wonderful problem to have, but they didn't really need the money. So they wanted to shift all these sites on because it was an administrative nightmare for them. They needed to liquidate some of them in order to obviously move on with some other stuff as well. But from their perspective, they had all this land. They didn't necessarily need all of the money up front. So it opened the door for us to actually say, well, look, let's pay you half now, half later. It enabled us to go and raise development finance against the half that we were paying up front and not put any deposit in. So from that negotiation point, we found what their pain point, it wasn't really a pain point to have lots of land, but what their issue was as such. And we solved it for them. And as long as you can find out what the pain point is for the vendor, and as long as you can find out what it is they need, then actually it's a really easy negotiation process. When it comes to vendor finance, we tend to find one of the easiest bits in order to persuade the vendor to sort of part with that cash again is if the purchase price is £1 million and you say to them, well, look, you're going to get the £1 million. What are you then going to go do with the £1 million? Well, if they're just going to leave it sat in a bank account, why don't they just give half of it back to you at 10, 15, 20%? Doesn't really matter what the interest rate is, but why don't they give it back to you on an interest rate and make money off it as opposed to it sitting in the bank and losing money? So that's one of the key negotiation points of vendor finance is actually, what are you going to do with this lump sum? If you're not going to go and invest in another property, if you're not going to go and invest in another business or another strategy or whatever, if you are just literally leaving it in the bank for retirement or so that you've got money to go on holidays and everything else, why not chuck a bit of it back into the deal? And we tend to find that's the easiest way to sort of start off that negotiation for vendor finance. And when it comes to vendor finance, you might find actually, once you start to open up that conversation with the vendor, that they're actually the one that suggests them putting money back in the deal. Because as soon as they hear that they can make 10%, 15%, and they can possibly have a second charge on the site, and they can possibly have a personal guarantee, and their money is secured, actually it starts to become a bit of a no-brainer for them. So we tend to find the negotiation process for that is a little bit easier than deferred payments, but as a whole, that's how we found approaching deferred payments and vendor finance. So when it comes to financing deferred payments and vendor finance, it's essentially what you're trying to do is reduce your deposit by getting the development finance lender to lend against the purchase price rather than what you're actually transacting on day one for deferred payments, or when it comes to vendor finance, getting them to lend against the purchase price and then having the vendor come in and make up that deposit. So financing with vendor finance is no different to financing with any normal investor, so there's nothing particularly tricky about that. It's just making sure that the development finance lender is happy with it, but nothing particularly that you need to worry about there. With deferred payments, it's a much tougher strategy for them to get their head around. We found it personally on all of ours, trying to get development lenders to get their head around deferred payments. Although it's not a particularly complex strategy, it is complex for them to get their head around because they see it as if it's £1 million and you're paying 500 grand day one, 500 grand on completion, they almost want to work off that 500 grand as the purchase price. But that isn't the purchase price. The purchase price is £1 million. So it takes that time to kind of get through development finance lenders and get them to understand this as a strategy. But if you can do that, then there's no reason why, if they lent against the million and you've deferred 500 grand of it, why they shouldn't be able to finance 100% of that day one tranche for you. And as many of you will have seen on social media, we obviously had a deal recently where the purchase price was 2.45 million. The day one tranche was 1.3 million, and we actually managed to raise 1.5 million day one. So in that scenario, we actually managed to raise 100% of the purchase price, plus an additional 200 grand for stamp duty and other fees and bits and pieces. And actually it ended up with, once the developers have paid their stamp duty and everything else, they had about 60 grand left, which has been great because they've been able to use that for cash flow to get the build started, to get the trees taken down. There was all sorts of different stuff that they needed immediate cash for, which they didn't really want to have to wait for the drawdown. So they went and spent 60 grand, which they had, which they wouldn't have had if they didn't have a deferred payment. And they've been able to go and sort of make decent chunks of progress without having too many delays. So that is how you would finance deferred payments and vendor finance, and there's some of the kind of pitfalls that you might come across on deferred payments. So the summary of the pros of deferred payments and vendor finance, without a shadow of a doubt, is that ability to remove the need for putting in a deposit. So simply put, that is the biggest pro of all of this, is removing that need to put a deposit in. It's, if you can get it negotiated, it is a strategy that will allow you to do much larger deals than you would be able to do with the pot you've got available, because it allows, like me for example, to go and do projects with GDVs of 4.5, 5 million, which if it was me having to go out and find investors and things like that, I just wouldn't be able to do projects of that size necessarily. So it's allowed me to take much larger strides than I would have ever planned on, and do larger deals than I planned on. And it's allowed me to just fast forward probably 3, 4, 5 years without having to go through the issue of, oh, let's do a 2-unit development, let's do a 3-unit development. I've been able to go straight in and do a 10-unit and then a 21-unit. So it's been great from that perspective. So without a shadow of a doubt, one of the best strategies for reducing deposits and allowing much quicker growth. When it comes to the summary of the cons of deferred payments and vendor finance, obviously the biggest one is going to be a negotiation, is trying to negotiate this stuff with the vendor. But if you can get over that hurdle, actually it can be pretty easy to do. Your other one is going to be getting the development lenders to understand, especially deferred payments, because they struggle to get their head around it. So it can be a very difficult strategy to, even if you manage to negotiate it, it can be a very difficult strategy to finance. And then even if you manage to finance it, it can actually be a very difficult process to legally wrap up. So there's always going to be these hurdles throughout this one, which you need to get through. Whilst it's one of the most rewarding strategies to do, it's probably going to be one of the most costly from a legal perspective. It's going to be one of the most difficult from a legal perspective, and it's probably going to be one of the most difficult from an actual financing perspective, because trying to get those development lenders to get their head around it is very, very difficult. And I can speak from personal experience, both on financing clients and financing our own, that it really hasn't been a particularly pleasant or easy experience. But we've gotten there in the end, but there's a lot of stress involved with this strategy compared to the other strategies that you can probably do. But definitely one to keep in the toolbox. But yeah, quite a few negatives to this one. So when it comes to negotiating a JV with a vendor, it can be quite a tricky process, because you're essentially asking the vendor to put their land into the deal, and for you to then go and raise finance against that land, with them taking no money up front for that purchase. So it can be quite difficult negotiating that. However, when it comes to it, you're trying to create a win-win for the two of you. So by them bringing in the land, it makes it incredibly easy for you to then go and raise the development finance. That's your win. You don't have to put a deposit in. When it comes to generating the vendor's win, you are trying to persuade them by them coming into the JV. Not only are they protected, because you've got to make sure that they're protected from if anything goes wrong with the development finance, so you've got to make sure that they're sort of as legally protected as possible, and they'll want that as well. You've got to make sure that they've got security. So in most formats, that's either a second charge behind the development finance lender for the interest in the land, or it could be a personal guarantee from you, for example. But when it comes to negotiating, you've got to make sure that they believe coming into that JV with you is better than putting the property on the open market. Now, 9 times out of 10, they're probably going to go with the open market. However, if you can put forward a deal format where they are making more money over maybe a longer period of time, maybe over 12 months, 18 months. But if they're making more money than if they'd put the property on the open market, then obviously that's going to pique their interest. And if they're securitized and feel legally sound within the deal, then obviously that helps as well. What I tend to find as a formula is, if you imagine if they sold the property on the open market, so let's say they sold it for 100 grand, just to keep the numbers nice and round. If you said to them, look, you're going to sell that for 100 grand, you're going to clear 100 grand. Okay, they might have taxes and things like that, but don't worry about that for now. But if you say to them, look, you're going to clear 100 grand, let's say they put that £100,000 into a 10% per annum investment somewhere. At the end of that year, they're going to have £110,000. So what I tend to find as a formula is, you need to find a way that persuades them that investing into a JV with you is better financially over that 12 to 18 months than selling it and reinvesting it or doing whatever with it. So in that scenario, you would have to say, well, look, if you come into a JV with us, we will give you £125,000, for example, as long as it obviously stacks up within the deal, which it should do, because you wouldn't be paying interest on the purchase like you normally would be, because they'd be bringing the land in as part of the JV. If you offer that 125, all of a sudden it's more financially appealing to them to actually have that. What you could also find out as well is, what are the pain points for the vendor? Are they looking to retire? Are they looking to go on holiday? Are they looking to buy a new car? Things like this. Just find out what their pain point is, because if it is that they want to sell it because they want to go to Disney World or whatever, they want to spend out on a 10 grand holiday, is there something you can do whereby you offer to give them 125,000, but actually they can take 10 grand early on? So at that point, actually what happens is they can go and do their holiday, and they can then sell the property over the following 18 months and work out better financially. So there's these pain points that you need to work out throughout that, in order to work out exactly what it is that's going to make them say yes. But if you can work that out, hopefully negotiating a JV with the vendor shouldn't be a huge problem. When it comes to financing a JV with a land vendor, if they've put the land into the deal unencumbered, without any debt and without any first charge or anything like that, let's say it's a very vanilla, we put the land in, you go raise the finance. So in that scenario, what should happen is, because development finance raises 65% of the GDV, and normally as a rule of thumb that works out about 60% of the purchase, 100% of the build, because you've brought the land in unencumbered, you don't need that 60% towards the purchase, because it's already in there. So what you should be able to do as a rule of thumb is raise 100% of the build costs, and actually you may even be able to raise a little bit day one to help with cash flow, or like we mentioned before, if you're negotiating with the vendor, there might be an upfront payment that you need to make, that could be included within that development finance. But normally the development finance would be able to raise 100% of the cost that you're looking for, because you haven't got to go and find that purchase, you haven't got to go and refinance anything, they brought it in, it's unencumbered, and they're taking a second charge. If they want to take a first charge, development finance is out the window, unfortunately, because senior debt, stretch senior debt, they need to take that first charge in order to lend on the development finance. So if the vendor wants to keep a first charge, unfortunately you're just going to have to go down the route of investors. It just wouldn't work with development finance. If they bring the land into the SPV and it's already got a mortgage on it, for example, as long as that mortgage is maybe 20, 30, 40%, again, it should still stack up enough that you should be able to raise 100% of the development finance for the works, and you should then be able to raise the 20, 30, 40% that you need in order to cover the mortgage that they've got on the property as well. Again, it could be a pain point for the vendor. They may just want to become mortgage free. Again, that could be part of the negotiations, that you clear that mortgage and then move forward with the development. So when it comes to financing it, JVs with the vendors, by far one of the easiest strategies actually to get financed. Yes, it's one of the most difficult to negotiate, but it's actually one of the easiest to finance, because you're bringing that unencumbered land, that asset, into the deal straight away. So when it comes to the legal process of doing a JV with the vendor, there are a few things that you need to keep in mind. So obviously the first thing is that they're moving their land into an SPV with you. So they're going from being the sole owner of the property to then actually sharing ownership of that property with you. So there needs to be clear terms set out within a shareholders agreement as to the shares involved and who owns what, and and how that side of things is structured. They obviously need to be legally protected to ensure that if anything goes wrong, they're not going to lose everything. And actually that's where a really good solicitor and a really good accountant comes into play, because you need to make sure that their shareholding, if you didn't want them involved in the development finance, for example, you need to make sure that their shareholding is below 20% so that they don't have to sign any of the documents or anything like that. But they need to be protected to make sure that they're still getting, if their share is more than 20%, that they're still getting the share that they're due come the end of that. So that's the first thing you need to sort out, is actually the legals of the company structure moving into it to make sure that they're protected against the development finance and everything else. When it comes to actually structuring the security side of things, if they want a second charge, for example, you need to make sure the development finance lender is aware of that and that their solicitor is aware of that, and that there's a deed of priority, which essentially means that the development lender, who's the first charge, takes priority over the second charge. There needs to be a deed between the two of those so that they work together to make sure that the vendor can't force a sale or anything like that. And that can be quite an intricate part of the legal process. And the last part that you sort of need to focus on within that legal process is actually how everyone's going to get out of it at the back end as well. And that may fall more on the accountant than the solicitor. It depends how you're structuring things. But there needs to be a way of saying, right, okay, well, come the end of this development, we will buy out the vendor for X amount and they will sell their shares back to us, or we're just going to close the SPV down if it's a sale. There's all sorts of things that you need to bear in mind throughout the latter part of that legal process and the sales process, to make sure that everyone can get out of this deal as well as getting into it. Because if you're looking to retain the units as well, it can be very, very difficult if you're building 10 units, for example. If the vendor owns 20% of the company, you've paid the vendor their bit, but then they retain their 20%, you've then got to move those properties out of that company into another company, incurring stamp duty and other taxes and everything else, rather than just being able to say, well, look, we've paid the vendor their 100 grand or whatever it is, their shares are then relinquished, and then you take over ownership of the company. So that is quite a complex legal structure that you've got to put in place in terms of making sure that there's that ability to bring the property in, do the development, and then sell it, and obviously get them out of the back end. So definitely get a good solicitor. You need a very, very good solicitor for JVs with the vendor, and be prepared for a lot of the vendor solicitor telling them not to do it and telling them all the worries and everything else. So there needs to be a lot of management during that legal process to make sure that they're looked after, and to make sure that they don't get cold feet at the 11th hour and then decide to move on. So a complex legal structure, complex legal process, but a good solicitor will get you through it with no issues whatsoever. So when it comes to the pros of JVing with the vendor, obviously the biggest one is the requirement for potentially no deposit. And then bringing that land in not only allows you to raise 100% of the build costs in normal scenarios, but actually the potential to raise a little bit against the land as well, to help with cash flow, to help with stamp duty if there's any requirement to pay that when moving it into the SPV, to pay for any of the upfront costs for the contractor. It just enables a lot more freedom and a lot more speed in order to get going, and it takes out a lot of the complications that we get when we speak to property developers, which is, I don't have the investors, I don't have the cash flow, I'm going to struggle to pay for X, Y, and Z. It gets rid of all of that, and it just brings you that freedom to be able to get on with the job and obviously deliver it potentially with no money down and no deposit. The other pro of obviously being able to bring that land to the table straight away is potentially speed as well, because the time it takes to move that land into an SPV is probably going to be quicker than going through a normal purchase. And obviously because the land is coming in unencumbered, etc., there's also that ability to move through the legals a bit quicker as well, because you're not going through the purchase. So they're sort of some of the biggest pros, really. The biggest one is just the fact for no deposit, and that really, I think, makes it one of the best strategies. If you can negotiate it, one of the best possible strategies for first-time developers or sort of early stage developers as well, because it gets rid of so many of the worries that development finance lenders have around experience, etc., because all of a sudden your leverage goes down because you don't need to borrow as much, so the risk profile comes down, so they're willing to take more of a risk on first-time developers and newer developers because you've brought this land into the deal. So yeah, without a shadow of a doubt, one of the best strategies I think you can do as an early developer. So when it comes to the cons of JVing with a vendor, obviously the biggest one is the negotiation process, because trying to persuade a vendor to go into moving their property into an SPV with you as opposed to selling it on the open market is a very difficult sell. And as we discussed previously, you've got to make sure it's financially viable. But the biggest con, without a shadow of a doubt, has got to be the legal process and the costs involved in making sure that everyone is protected and making sure that everyone is looked after throughout that process. And also the constant back and forth, the constant negotiating, the constant vendor solicitor saying, don't do this, don't do that, don't go into this deal, etc. It can really put some fear into the vendor. So one of the things I would say is be prepared potentially to lose quite a bit of cash when going into a deal, because you could get quite a bit into the legal process. They could take counsel from their solicitor, all of a sudden be told, oh, we don't think you should do this, and all of a sudden they pull out the deal and you lose everything that you spent on the deal to that point. So I would try as early as possible to lock vendors in, make sure they understand the process, make sure they understand the risks, make sure they understand the process, get good accountants involved, get good solicitors involved, have a complete process from start to finish ready to go, so that when you present it to them, they understand everything that's going to be asked of them. Get them to take legal counsel before you start the process, because if they do that later down the line, there's a worry that you're going to have spent loads of money and obviously lose that. So make sure the vendor is secure, happy, ready to go as early as possible, because the last thing you want to do is spend out on valuations and QS fees, monitoring surveyor fees, legal fees, all of these fees, only for them to pull out at the 11th hour because they've realised it's too risky for them or something like that. So without a shadow of a doubt, you need to make sure that that vendor is locked down as early as possible. And one of the last cons is obviously just making sure that you understand the tax implications, how you're going to get the vendor out at the back end, how the shareholding agreement is going to be sorted, how everything else is going to be structured to make sure that not only can they get in, but they can get out as well, and to make sure that you're protected in their exit as well. So a few cons just to keep an eye on, but if you can get over those, it's definitely one of the best strategies that you will take on.